Hello there. Welcome to Unit 5, Options Pricing. And we're going to talk about how to utilize options. And I'll stress to you as we've getting towards the end of the semester here in some of our content, obviously the units have gotten progressively harder in terms of the concepts that we're trying to talk about and show you how they will be implemented into your green marketing scheme. And options are the most difficult tool to understand how they work and how they can be used in some ways. So we'll try and take this section slow. I'm going to split this video lecture up into two segments to try and keep the time down. And you may, of course, review them as often as you like. So what's an option first off? It's the right but not the obligation to buy or sell a futures contract at a specified price and time. It's exactly why they call it an option. So basically, what you're specifying when utilizing an option is the right to buy or sell a futures contract, the commodity, and a certain price. And the lifespan of that option is about 1 to 2 weeks prior to the delivery date. So we'll be working to try and explain through this video lecture very carefully how you would implement this into your marketing plan. So furthermore, what is an option? First thing that we talk about when taking out an option and what you're going to buy at is what we call the strike price. It would be related to what's being traded at on futures, but different. So here, instead of a futures contract or a forward cash contract where we're simply settling for or agreeing to the price that's being quoted, now we have a range of prices that can be selected for. So if we're putting on a put option, we'll talk about that more specifically, which is a floor to the price. The lower the floor, the cheaper the strike price premium is. The higher the floor, the more expensive the strike price premium you will pay. And we'll utilize some assessments and worksheets in class to help subsidize our learning here on this and help enhance what we know. The strike price, once you select it, it's not going to change, whatever that option contract is. And again, we're talking about 5,000 bushel option contracts here. The premium is paid to the seller of the option. So, for example, someone that's going to be a buyer is going to offer a put option for sale. So that could be, again, high or low based upon the strike price level. So again, there's two kinds of options, a put or a call. A put would be purchased by an individual that has the commodity to sell. A call would be purchased by an individual that needs to buy that commodity. And likewise, both of those individuals could sell those things. So, for example, a producer that's making or growing corn and soybeans could offer a call for sale that a corresponding buyer of product may want to buy at a certain strike price. So that's how this works a little bit in a nutshell. I'm sure it's going to be confusing a little bit until we get to class and get to go through some worksheets and apply these concepts. So as we go through an example here, and again, these are very old prices. I need to update them. So for example, if we wanted to utilize a put option, again, that's giving us the right to sell a futures contract at a specified price, so that strike price. So a December corn 260 put is an option that gives you the right to sell these corn futures contract for 260 and nothing lower than that. So it somewhat, like I said before, locks in a floor. If you slid down 10 cents to the next lower strike price in the range at $2.50 a bushel, then that would have a lower premium and so therefore cost you a little bit less. So again, we're talking about utilizing put options to lock in a minimum price for the sale of commodities. And if the price rallies, you get the opportunity to benefit. That's why they call it an option. So for example, if we go back to the top of the slide here where we purchased that put option at $2.60 strike price, and futures rallies to $3.25. We let that put option expire and take the higher price or offset it with the futures contract. That's generally the advantage of using a put option. The question is how much did that cost us in premium? and how do you execute it appropriately. So again, for a put option, which would be most common on the producer's side in terms of buying it anyway, a buyer of a put option, you can exercise the option, which means you're going to exchange it for a futures contract, offset the option, which means sell it back, or let it expire. And the most common one is to exchange it for a futures position. Oftentimes we're going to execute a put option, let it ride, and therefore lock in a floor. And then before we ever get the opportunity to deliver grain and it reaches that maturity 1 to 2 weeks before the month of the contract, we're probably going to trade it for a futures position and get out of it. So here's another put option example. We bought a December hog put at $46. The strike price, again, $46 a hundredweight. If price falls below $46, we could sell the put and receive a premium. Okay. If the price rises above $46, we're going to let the option expire and take advantage of the higher price. Essentially, we've locked in that $46 price as the low end. Again, most are going to offset these for futures contracts. That's probably 95% plus of how put options are employed. Very few of them actually end up exercising the option. There's almost always a better marketing opportunity to offset your put option prior, or they just simply let it expire. But bottom line is, if you were paying attention and if you got in at the right point of the put option strike price, you've locked in a floor. Now you just need to exercise the right strategy getting out of that put option. So conversely, what is a call option? A call is the right to buy a futures contract at a specified price at a specified time. So this would be utilized by an end user who's wanting to, again, put a cap on the amount that they would have to pay to buy corn, for example, on this slide. So let's say that, a buyer at a local ethanol plant trying to, again, cheapen up the amount of money they spend on purchasing corn, they noticed that they could buy a December corn call at $2.30, and that's going to give them the right to buy December corn futures at a strike price of $2.30. That locks in a maximum for them. Again, the opposite, equal and opposite position that a put option on the seller's side does. Again, same thing in terms of strategically. They can exercise that option, they can let it expire, or the most likely outcome is they're going to offset it with a futures contract position at some point in time in order to cash in on hopefully a profitable market movement. If the prices rise, they're going to sell that and probably take the premium, get a premium. If prices fall, they're going to let it expire or trade it for a futures position and take advantage of a lower cash market. Either way, the call option is designed to help put a cap on the amount that they would pay for that commodity per bushel. So that's how these things work. Now, who sells the call option? And that would be the producer side. They could sell that call. An end user is going to buy the call. Likewise, the end user could offer a put for sale, and the producer would buy that put. So it's how it trades back and forth is kind of the interesting relationship here on how we use options, puts, and calls. So again, how do we compare these two things between put and call? I've tried to put together a slide here that shows calls on one side, puts on the other, and what the relationship or the characteristics of who would purchase them or sell them. So hopefully this is a good summary slide for you. Premiums now. Again, these contractual obligations aren't traded for free. There's an option premium, so it's the amount you pay when you buy an option. So the premiums vary with the strike price. So the more risky the premium position, or the options position is, the higher the strike price is going to be. And that's determined by traders in open outcry bidding, same as what we've talked about with regard to futures trading. That's going to happen generally in the market. Again, the more risky the position, the higher the strike price. But also, if you happen to get in the right position, the more profitable it would be. So what affects premiums? Again, the relationship of the strike price to the current futures position for the same contract. So, for example, December corn futures are trading somewhere around that $4.05 a bushel mark today. If you wanted to buy a put option at $4.75, it's probably going to cost you quite a handsome amount in terms of premium. Now, that may work out great, and you may come out on the right end of that, but it's a fairly risky position, and what you're doing is taking the chance that it will rally well above that. So that would cost you quite a bit to do that. Conversely, again, trading at 405 roughly today, a put option down at 305 is probably going to be relatively cheap, if not no premium whatsoever. They'll let the market fall that much and not let you worry about it in that regard. But you're also not helping yourself potentially if the market's currently trading at $4.05. So what we're talking about here is essentially the time value of money. And you're going to be tracking closely what the time remaining is before those options expire, so you know what to do in terms of offset it or whatever. So we're going to be looking at intrinsic value. Again, I mentioned in the previous slide, time value of money. Again, relationship between the strike price and the current futures price. So if we look at a put option, put options and call options are going to be calculated a little bit differently in terms of intrinsic value. So a put intrinsic value is the strike price minus the futures price. And it can never be a negative number. So in the first example here, if we look at the strike price of $3, a futures price of $2.65, that intrinsic value is 35 cents a bushel. So essentially, that put option, if you bought it at $3 and futures falls to $2.65, you're making 35 cents a bushel. It's kind of similar to the T account concept that we talked about earlier. If conversely, strike price is at $3, we bought the same put, futures price rallies to $3. Right now, our put doesn't have any value whatsoever. So our put's not really doing anything for us. It didn't save us any money, so to speak. And then the final example, if strike price again was $3, we bought a $3 put, futures rises to $3.20. Again, our put isn't, we're out of the money in our put, and it didn't necessarily make us any money. We're probably going to trade it for a futures position on the other side to try and cash in on that. But that's how they calculate strike price intrinsic value. Like I said, same thing, we would calculate intrinsic value of a call if you were an end user. And notice a call intrinsic value is futures price minus strike price, the opposite equation that we just covered with a put. So futures, example here of corn, $2.65 a bushel, and we purchased a $2.40 strike price call. That intrinsic value is 25 cents, okay? If futures and strike price is equal, it's 0. And then if futures falls to 230 and our strike is 240, again, it's not a negative number, it's just 0. There's no value to that call whatsoever. So that's how we calculate intrinsic value. We'll be practicing that in some of our activities in class. So there's a couple of computerized models, and I'm not going to spend a lot of time talking about this, that basically predict the theoretical options values and how advisors that help you with these kind of things can help guide you into at what point is a good time to enter a put or a call option, to buy a put or sell a call. So it's discovered through, again, the exchange trading arena, but it's a computerized modeling feature that applies some market information in order to help guide you in your decision making. So there's a number of different things here. Again, I'm not going to spend a lot of time through this section because I think it will just bog us down in terms of our mastery of this content. So I'll skip on through some of these predictors, what they measure. You're welcome to pause the video and review the slides here as what these predictor models are. the delta, theta, vega options and kind of what they're looking at. I really want to more focus on through this section on how we would employ these in our marketing strategy. But more than likely, you're not, as a producer, probably going to utilize these computerized models. You're going to employ somebody as a broker that's going to have this and help you basically interpret how that put or call option works for you. So I'm going to wrap up here with the first segment of this video lecture at about 15 minutes here so that you have the opportunity to take a break and then come back and listen to episode 2 here in a moment. Thanks for tuning in to the first part.